we're kind of playing chicken politically. The Fed said, we don't need rate cuts yet. They dug in their heels. As soon as Vice Chairman Barr stepped down, a lot of speculation was swirling around that Mickey Bowman would be appointed the vice chairman for bank supervision. But the Trump people seem to be in no hurry. So really what you have is, on the one hand, the normal discussion about interest rates and the Fed, but then you have Capitol Hill, where we're looking at a potential government shutdown. And we may also see various other machinations around the debt ceiling, default, all of this, right? So that's another vector that the Fed has to think about at this meeting. Do they say anything about it? Several governors have said that they may have to stop the shrinkage of the portfolio if the Treasury, essentially goes to the wall again and has to face a debt ceiling fight. So there's short-term and medium-term issues in front of the Fed this time, and it's certainly not clear. That's not going to help the markets very much at all. Look, I think to the extent that people were hoping to see lower rates, both to help the economy, to drive volumes in terms of new lending, and also to bail us out of that still persistent mark-to-market problem we have with all of those old mortgage securities. We published a list of banks based on the yield on their mortgage book today. It's a fascinating list. There's banks in there that are cleaning house, and there are other banks that are not cleaning house, that are sitting on their hands. Yeah. That's not really good for earnings. So that hasn't changed. If we see the 10-year Treasury get up to 5% instead of closer to 4%, where we are now, we're about 4.30, then the alarm bells start ringing with the banks because they have a problem. It's an earnings problem and a liquidity problem at the same time. Now, we just saw the FDIC announce that they're not going to tell us the total assets of troubled banks anymore. This is a change from 35 years of practice. And I think that people should ask themselves, why did they decide to make this change, number one? And why did they decide to put out a public statement about it, which I don't think was a very good idea. There are dozens of banks out there that need to be resolved because they are insolvent due to this securities issue. A lot of credit unions too, by the way. Yeah. So it's not like there aren't issues out there. It's just a question of whether somebody in Washington wants to deal with it. I must say, Joe Biden and the cast of characters that he had around him left a big mess behind. I don't think the Trump people yet fully understand just how big of a mess it is in housing, in banks, multifamily housing, which we've written about. So there are a lot of moving parts here. And technically, is the Fed supposed to think about this stuff? Not really. They're supposed to think about employment and inflation, but they do have to be cognizant of what's going on in the credit markets. Well, financials have been giving back ground, obviously. JP Morgan got to 2.5 times book, which was pretty fully valued, and we've been giving back since then. There's only a couple of financials that are still up, Fannie Mae and Freddie Mac, obviously, the great pump and dump trade around GSE release, and one or two others, Compass, a real estate company. But I think the optimism that drove valuations last year has certainly cooled. People have talked about the Trump put or the Trump call, but the reality is that the uncertainty and the volatility of policymaking decisions is causing the markets to step back a little bit. And I think most advisors are delivering that message of we don't know what's going to happen next, because this is part of Trump's strategy, shock and awe. They are very well prepared this time. They are putting butts in seats. They are going out and making significant policy changes. And many of these changes kind of had to happen, but there was no consensus in Washington to do anything until he arrived. So we have to just deal with the fact that we have an activist president who likes to fight with people. He loves to fight with other countries because it's kind of easier than fighting with domestic opponents. And I think it's going to be kind of like this for the next 4 years. Well, the stock market is the political proxy in America, for better or for worse. It has been for a long time. The people don't focus on the bond market nearly as much. It's kind of geeky and technical, but it's probably more important to the extent that we're still looking at 6% mortgages instead of 5s. And, the corporate sector has rallied a lot. A lot of people have been out raising money at very, very attractive spreads. So the whole market really was fully valued coming into the end of last year. We had President Trump take office, and that kind of love affair lasted for 2 or 3 weeks. And then you saw the techs and a number of other sectors giving ground. I'm almost back to my exit point in NVIDIA, so I'm kind of looking at that. But I think really the ideal asset classes for investors have changed in the past 12 months. People are thinking about more defensive stocks. A lot of people are looking for yield right now in the markets. And then, of course, we have the advent of distressed credit as a retail investment category, which I can't, say enough about, really. This is going to be a different year. I don't think financials have any particular reason to rally yet. We were hoping for lower interest rates to come and rescue us, but that has not occurred. It may not happen till the second half of this year, and we may only see 1 or 2 rate cuts during the entire year. So that changes the narrative a lot for financials and for stocks generally. The industry has about $3 trillion worth of mortgage-backed securities. The average yield on that book is about a little less than 3%. If you look at the market today, Fannie Mae 3s for delivery this month are trading at about 82. So you're talking about an 18-point loss if you sold those securities today. What that tells you is that the cash flow for banks' earnings that are generated by the securities is quite low because the cost of funds in the industry is 3% now. So if you own a bunch of Fannie Mae 2s or 1.5s, and there are quite a lot of those still in the marketplace, you're losing 1.5 points on funding, and that hurts earnings. So that's why this is important. The industry has hoped that the Fed was going to drop rates significantly and bail them out of this problem. If we got Fed funds back down to 4 or 3.5, a lot of this problem would go away, we hope, because the 10-year would rally too. But this is the big question in the age of Donald Trump. If the Fed drops short-term rates, are we going to see a rally in the long end, or is it going to go up more? Because people are worried about the deficit. They're worried about interest rates. They're worried about other factors, but they're really worried about the deficit now in ways that they weren't before. So I think that is the big question mark going forward. How much of a separation or bifurcation are we going to see between Fed policy on the one hand and the Treasury's concern, which is longer-term interest rates? And, the Secretary, Scott Bessent, he said, the Fed's problem is short-term rates. Long-term rates are my problem. He's trying to grow out of the problem. They think 3% GDP growth, basically gives them a little breathing room on the federal deficit. Overall, the economy on average, which is always a dangerous word, is doing fine. We could actually see up GDP growth this year with relatively low unemployment. That number has really not jumped up. So there are parts of the economy that are doing quite well. There are parts that are not, though. And that's really the question. Is the lower income, lower credit score world of, say, consumer finance and autos and mortgages getting to be gnarly? Yeah. Defaults on auto loans are rising, particularly subprime, but even prime loans owned by banks, you're starting to see elevated delinquency. And then, the mortgage mess left over by the Biden administration is considerable, both for residential and multifamily. So I think there are hot spots in the economy that are certainly going to cause pain and losses. But overall, we're going to go into a recession this year? No, I don't think so. I have been actually very much on the side of no recession going back to last year. The credit card defaults are up, yeah, but it's not the end of the world. And, people often look at the dollar amount of defaults and say, oh my God, Chris, look at that. But I remind them that the credit card book has almost increased by 2.5 times compared to 2008. The industry's got $5 trillion worth of unused credit lines out there that they would like you to use, please. Right now, go out and do some shopping. Mm-hmm. So what I'm telling you is that utilization is relatively low, 20% of the outstanding available credit for consumers. You don't yet see signs of banks pulling in credit lines and cutting people off, no. The only area where that's the case is commercial real estate, where banks have been backing off a lot. And what's really interesting, which we can see over the past few years, banks aren't taking property when they come to a problem with a loan. They don't want the building. They will forbear. They will cut interest. They will do anything they can to have you stay in that building because they don't want it. And that's a big change from years ago. You also see a huge amount of float of earnings that banks have reported but haven't collected yet. $100 billion. That's more than a whole quarter worth of earnings for the industry. So there are a lot of signs out there of credit pressure, but no sign of recession yet. This economy is going to keep on growing. People keep thinking that some of the policy changes put in place by the Trump administration are unintentional. No, they're very intentional. And I think for those who hearken back to the old days of Joe Biden and even before, you have to realize that Donald Trump is intent upon change, structural change in how the government works, how it pays for itself, And he is trying to make some, I think, very long-lasting changes that could accrue to the benefit of the Republican Party. The Democrats are still not capable of having this conversation. They don't like the idea of change in their own trajectory in terms of bigger government and that sort of thing. Trump is coming out with kind of a Jack Kemp sort of message we haven't heard in 20, 30 years that says, no, the private sector has to lead growth. So that's a fundamental difference. And I think that over time, people are going to realize that the changes Trump is making, he's going to try and make with Congress, are going to be quite significant in terms of how this economy operates. I think a lot of the changes that Trump is putting in place with respect to the Europeans, little things like Bretton Woods, you remember that one from your high school economics? That's all going by the by. And also the role of the dollar as the leading reserve currency in the world. That's going to change. That's the implication of what Donald Trump is doing. He would like the U.S. to not have to pay for everything. He would like the U.S. to be involved in fewer military operations around the world. These are things that are fundamental conservative doctrine, and going back to Senator Robert Taft, for God's sake, when I was a kid. We haven't had these sorts of ideas in the mainstream conversation in the U.S. because, most people, I think both Republicans and Democrats, were kind of content with the way things are. What Trump is saying is that things have to change. And that is a challenge to many people who are just not ready to have this conversation. It's quite disruptive. When you start talking about shutting down governmental departments, the changes made in housing, for example, for lenders to get loans done is a concern. We're a little bit worried about what this looks like by the end of the year. There are a lot of questions as to how we get things done the way we were doing it a year ago versus, say, a year from now. I think there's an education process that Trump is going to have to get on in terms of making people more comfortable with some of the changes he's proposed. But clearly, you can't grow out of your debt if the government is the biggest sector of the economy. The debt-driven government spending actually is very harmful to the economy over time. Because remember, we're rolling that debt. We're refinancing that debt. A quarter of all government debt's now in T-bills, by the way. So, when you look at it that way, that dollar that was spent for whatever purpose by the U.S. government 5-10 years ago that we're still refinancing, that's not helping us. That's killing us. That's the basic problem with public sector debt. The private sector is, it's about growing equity. So that's why it's so different. You're not creating any value. You have deficit spending by government. I think you're going to have to be a little bit more selective, both about specific assets and sectors. Last year before, you had this huge boom surrounding AI, which is kind of the latest hype from Wall Street. We've had many others. I am, somewhat skeptical about AI because it basically is taking the known universe, putting it in a computer and letting the computer figure out what the averages are. And then you throw some other tools on top of it. But what are we doing? Are we really advancing knowledge? Are we coming up with artificial intelligence? Or is it just simulated cognition? I think that's the latter. That's the way Ray Kurzweil used to describe it. And you see this always happen. A lot of people that were skeptical of this initially jumped on the bandwagon. God, NVIDIA was up, 800% over a couple of years. And so the huge amount of attention that drew, and there were other stocks as well that went along with that, I think has now subsided. So the question is, where do we go now? And I think it's very interesting. A lot of investors are actually looking for yield instead of capital gains. My attitude on gold, as I talk about in Inflated, is gold is still the only form of money that's not debt. We then have various types of debt, including our beloved dollar. And then you have the next phase, which is crypto, which is nothing. Why am I so skeptical about crypto? Because it violates the basic rule of fair dealing. If you give me something, I give you something. That's called a fair deal. If I give you my legal tender dollar and you give me nothing, which is crypto, what do I have? I have an option on a greater fool. So if I can find somebody to sell that nothing to for more than I paid for it, then I make money. I'd rather play poker or even dice. I think it's more fun.